Hey YouTube, it's Dale Cooper here. If you watched one of my most recent videos where I unboxed this 100 gram Pampa Suisse gold bar, you saw that Provident Metals sent me a free issue of American Hard Assets magazine. So I was flipping through it and it's interesting. Nothing I really need in my life on a regular basis, but on the last page there's a column called Hindsight, and there was a pretty decent article that I thought I'd read you guys. It's called The Impact of Geopolitical Events on Gold by John W. Garibald. Nothing really earth-shattering, but just kind of a good reminder and sort of something to keep in mind. So it goes, with headlines currently chock full of Russian aggression, metals have caught a little bit of a safe haven bid. Many metals investors look to these sorts of events for an increase in the spot price and premiums on their physical. The reality is that very seldom do the temporary, headline-driven rallies last, and that many of the producers will actually look to fade or sell into the rise. The question remains then, if gold is supposed to be the ultimate hedge, why are metals not higher when Vladimir Putin is threatening to reunite the USSR one gas-rich strip of land at a time? As with most things in financial markets, the answer is multifaceted and nuanced, but there are at least some primary contributors to study. The first is that the global metals market is huge. That sounds a bit obvious, but the actual numbers are astounding. The London Bullion Market Association, long considered the hub of the world's gold trade, estimates that the total transfers of gold between clearing accounts in 2013 were 570,000 tons. That is a US dollar value of 26 trillion. The GDP of the United States is 15.68 trillion. Russia is at 2 trillion if you're keeping score. These are big numbers, folks. Admittedly, very little of that metal is delivered as physical, and much of it is counted in duplicate. A mine selling to a bank, selling to a mint would count the same ounce twice in a single session. But even the physical demand for last year was almost 5,000 tons. The events required to shift this market are not just small spikes, but macro-level trend changes. Even when the Federal Reserve first enacted quantitative easing, in late November 2008, the initial moves were small at first. The barbarous relic, in quotes, it often takes investors time to come around to the idea that a larger share of their portfolio may need to be attributed to metals for a coming storm. As new paradigms are formed and staid monetary policies wildly thrown into the breeze, the momentum grows and the financial players begin to pour money into hard assets and anything in particular with stability. Inevitably, investors will refer to the inflation hedge component of gold demand. While that is certainly useful, the much larger long-term contributor statistically is the direction and level of real rates. If interest rates are below the prevailing rates of inflation, we are in a negative real rate environment. These scenarios are usually very bullish for gold, as the broad levels of consumer prices are rising faster than what you can generally get for treasury rates. This sends investors looking for easily held hard assets, and metals top the list. The issue is that inflation can be very localized, especially at the extremes, and local phenomena are not usually large enough sources of demand to affect the overall market. If Venezuela, with a $380 billion GDP, is running an inflation rate of 57%, which it is, and locals are buying with both hands, it still is not enough to move the needle. Sure, some local premiums for physical bars will pop higher and global shipping routes will adjust to meet demand, but it still cannot make a dent in the global price. When financial players view the global landscape, there are much better methods for playing a local crisis than through the macro lens of gold. Fortunately for us both, this is a hard assets magazine, so we will leave the rates and currency discussions to another forum. The summary here, folks, is that trying to trade the headlines or data points in gold is akin to roulette. You may win, you may lose, but the house will take their spread and the odds work against you. Much better then to take a longer view of markets and average your costs. You'll be much more financially secure for it. So that's it. I just thought it was an interesting read and a good little reality check to keep in mind with all that's going on in the world right now. So keep stacking and talk to you guys later.